Good morning, everyone. Thank you so much for joining us. We are here on Friday to talk about Riot and the volatility in the blockchain sector that is going to create so much opportunity out there. So, I want to first take a look at some of the things that are going on in Riot. So, of course, Riot is the blockchain miner that is out there mining cryptocurrencies. So, for anyone who's not super familiar with the Bitcoin space, the role that miners play in the ecosystem is incredibly important. Their job is to constantly verify and validate the transactions that are happening. And in addition to validating the transactions that are happening, they're constantly mining or solving algorithms to create new Bitcoins. Now, this is an incredibly expensive process. It uses a lot of energy. That's one of the critiques of the system. But effectively, the ability to create one of these mega farms that is running there, I believe they have thousands of computers that are mining actively Bitcoin and solving algorithms. They're producing a lot of Bitcoin. So when the price of Bitcoin is going up, the asset that they are producing using this electricity, which is a relatively fixed cost, is going to also go up, and they can sell their product for increasingly high prices. That's probably why stock has been on an absolute tear recently. So stock is correlated with Bitcoin something like almost 90%. It's very much an input question here. They are producing Bitcoins and they are able to sell them at a higher price. So of course, as the price of Bitcoin has doubled in the last couple of months, we're also seeing some really interesting price action with Riot stock. However, one of the big differences between Riot, the stock, the equity, and Bitcoin itself, as the underlying asset here, I guess, is that volatility in Riot is almost twice as expensive as volatility in Bitcoin. So we'll see in just a minute, but I'm going to be looking at trading somewhere around 50 days out, so a little less than 2 months. The implied volatility out there is over 200. Now, Bitcoin is certainly not a low volatile asset, but it's only quote unquote trading in the 110s, 120s. When we saw a little bit of that drawdown earlier, we got up into the 130s and 140s. That said, or all that said, Riot's still trading at a pretty significant premium there. Of course, there are other questions about a company other than just like its specific, holdings, but the vol here is certainly very expensive. There's still a lot of evolutions going on with Riot. There are good reasons why people are bullish on this. One of the kind of headlines is this idea that they're becoming increasingly efficient. To the extent that they can use their energy more efficiently, produce Bitcoins faster, that's going to improve the quality of their business overall. So there are reasons other than just Bitcoin that one might be bullish on Riot, the stock. But let's pull up some of the trade structures that we could look at here and consider if you were bullish on Bitcoin and wanted to use Riot as a proxy for that. How would we think about that, and how can we capture this really expensive volatility? So I'm going to go ahead and pull up my screen, and I will get a little bit out of the way here also. So like I mentioned, I'm looking out just a couple days, more than a couple days, I guess, out about 48 days to the April expiration. You've heard me say it before, but liquidity on these serial expirations is really important. We do have a lot of these weekly expirations that you can see, but that said, if we're going to express this thesis, this is something that we'd look to see over the long term. We know Bitcoin is a very volatile asset, but if you're generally bullish on this in the medium term, you are going to want to look out a little further. There's a bit of a gap. We have a 50-day expiry in April. And we have a 110-day expiry the following June. So let's focus on April and that sort of 220 vol that we have out there. Markets are relatively wide here. So as always, execution quality is really going to matter. But you can see that the 46 at the money put right now is 1360 at 1680. So that's $3.20 wide. The call is only 75 cents wide, but overall we're seeing some pretty wide markets. Important to navigate these, especially as you're doing spreads. That's going to get expensive and that's going to add up. So what I want to set up here and think about as a way to express that long-term bullish opinion might be what we at Harvested Financial call our version of the Mata fly. So that's a broken wing butterfly, but we don't really particularly like to call a trade strategy broken. So we call them the Mata flies because puns are very clever and interesting. So what I want to do here is if you're looking at this expensive volatility, you're going to want to consider selling that relative to Bitcoin. So one way to capture that is to enter this trade structure that's going to be net short. And if you're looking at a price jump of, something like 30%, let's set 60 as our top target. Now, a lot of the Bitcoin bulls certainly think that's a possibility, and the options prices in Bitcoin themselves reflect that. So, as a price target of 60, I'm going to set that as the middle strike here. And so that's going to be the strike that we're short. And that's where we're going to be capturing all of that, sort of volatility premium that's going to bleed out as stock continues to run. So I'm going to set up a broken wing butterfly, and by broken wing, I mean the legs are not equidistant apart. So a traditional butterfly, if I have 60 as my middle strike, I'm going to go $10 up and $10 down. With this modify, I'm going to go $10 up and buy the 70 put, and then I'm going to go $15 down and buy the 45 put as protection. So as you can see here, the markets are relatively wide. I'm looking at a 610 offer and a 56-cent bid. The midpoint on this trade is $2.78. So that's what we consider our theoretical value for a trade like this. But it's really important to note how wide those markets are. There's a little over $3 on either side of these. So a lot of things to pay attention to as you're getting in and executing. So what does our P&L look like in this type of trade structure? Well, the best case scenario is going to be if stock goes to our short strike. That's actually a truism about all trading strategies, is that if stock goes to your short strike, that tends to be the maximum profit zone. If stock goes to your long strike, that means that long option that you hold has decayed completely, and it doesn't have the opportunity to sort of benefit from movement that we want out of long options. So on the other hand, short options, we want them to go exactly to that price. So our max P&L in this scenario would be at that 60 strike. And if we get this for a $2.78 credit, so we're capturing a credit at the initiation of the trade, I don't know that you would actually be able to go out and get that 278 price. Probably a more realistic fill is something like 250. But all depends on the markets, and especially with the markets in flux, that's something to pay attention to as you're looking at the entering into your trade. So that 275, let's run with that theoretical price that you would capture, that ends up being your max profit zone. So if stock really runs, you're still going to be in that max zone. This is expressing a very bullish directional bent here. And also because we set that short strike up a little bit higher, it's even further bullish on the trade. So we do see a max profit of over $1,000 per contract if it does go right to that 68 target. Now, our downside risk is only about $220 a contract. That's really nice because anywhere essentially below where the stock is trading right now, we're going to have a defined risk in this type of position. So for option strategies, that's a really important feature to add in there, that while you might want to make a speculative bet on the upside, going long the equity purely exposes you to unlimited downside risk, or limited all the way to zero. But with this option strategy, we do have protection below the current level. So if you want to capture this really elevated volatility and lean bullish, butterfly strategies present the kinds of structures that will allow you to profit from both of those. Setting the center strike higher and selling that will give you exposure to both of those features. This type of systematic strategy works over time too. To the extent that you want to continue to stay bullish, there are opportunities to roll this going forward, potentially capturing opportunity as volatility comes in. This trade structure would profit also. So this is a way to actively manage this too. And in many ways, this modify forms the bedrock of our model portfolios here at Harvested Financial. So make sure to subscribe, make sure to check us out on our website at harvestedfinancial.com, and make sure to check us out on Twitter also at harvested_DAFE, because derivatives are for everyone. So thanks for tuning in again. We appreciate you. Again, hit the subscribe button. You'll get the Daily Bread every day into your inbox. And we'll be here every morning, 8:35 Central, 9:35 Eastern, to talk about option strategies and how they can fit into your portfolio to really lean into the markets. Thanks so much. Have a great day trading. It's Expiration Friday.